Hi and welcome to your Learn CIMA tutorial on the approaches to strategy. Now this is for the E3 examination of the CIMA exams, and it's one of the first topics you'll be taking a look at as you start to study this interesting subject. Now the first question that comes to mind is, well, what exactly is a strategy? And you might think of companies that have done rather well over the years. For example, at the moment, you might say Apple is a very successful company. Whereas you might comment that Microsoft is less successful than it was. Toyota is the largest car company in the world. Well, once that was General Motors. So Toyota followed a strategy that's been very successful and has allowed them to overtake General Motors. So we can't really define strategy in one or two words. What we can do is say that strategic decisions have certain characteristics. They impact upon the company's future prosperity and survival. A very common definition of strategy is the organization's fit with its environment. And that means what satisfaction is given to its owners, its investors, other stakeholders. Is it meeting customers' needs with the products it makes? What risks is it running? Now the point about a strategic decision is that sometimes when you make them, you don't realize they are strategic, but the outcomes of them may take many years to come through. And finally, because they take a long time, a strategic decision always takes place under a situation of uncertainty. You don't know about the operating environment in which you're trying to actually make these decisions. A strategy can take place at a variety of levels in the company. If you were taking this paper 30 years ago, then strategic decisions were synonymous with corporate strategy. Today, we talk more about business strategies and functional strategies. So if corporate strategy still exists, it talks about the growth of the corporation. It talks about things like its compliance and the overall organization's sustainability into the long term and its fit with the natural environment. It will concern risk management, stakeholder relations, and the kind of decisions it will involve itself with will also be things like mergers and acquisitions. Many firms today have broken themselves into separate business units, different products in different countries. And they will have a competitive strategy as a business strategy. And they'll be concerned with their own particular products and markets. A functional strategy is a strategy of a particular business function. And you might remember these functions from your studies at E1. So things like the HR strategy, the IT strategy, manufacturing strategy, supply chain strategy, and even the financial strategy. And in the examination you'll be taking, you'll be looking at all of those functional strategies as well as the business and corporate aspects of strategy. So what's involved in making a strategic decision? Well, according to two writers, Johnson and Scholes, it starts with an analysis of the business, its goals and its environment. They then have to make choices as to what the business is going to do, and finally to implement those choices through things like devoting resources, performance measurement, and so on. Now, Johnson and Scholes break that down further, and this diagram here is extremely useful in understanding some of the concepts and topics we'll be covering in our E3 studies. So the strategic analysis will look at things like the environment of the business. That means its investors, it means its customers, it means its competitors. It will look at things like culture and stakeholder expectations. The stakeholders are the people for whom the organization exists, or whose money it needs to survive. Its customers, its investors, its suppliers, and of course also things like government. The analysis will also look at the resources and capabilities of the organization. There's no point in trying to pursue a strategy that the company does not have the resources to reach. After that, there is strategic choice to be made, and that choice is things like identifying the options available to the company and where it might go next. Having identified options in a sort of a blue sky session, it will then need to evaluate those options, to evaluate the financial return and the risks and the degree of commitment needed to make them work, to secure top management support for them. And then finally, it will select the strategy or strategies it intends to follow and put those into action. Now, putting them into action is implementation of strategy. And here we see some important points. For example, the planning and allocation of resources. Now, that's not something you're going to have to study in E3. As far as a management accountant is concerned, that's things like budgeting, capital forecasting, cash flow forecasting. But there's also going to be organizational aspects. the organization's structure may need to be changed or redesigned to accommodate the new strategy. For example, opening an overseas operation, shutting down an operation, combining business units. And critically in the syllabus, for 20% of the marks, is the management of strategic change. How do we take the company from where it is to where it wants to be and carry the people and stakeholders with us? Now, the main perspectives on strategic decisions that you need to know about are the ones you can see on the slide here. We're going to review the rational planning approach, emergent strategies, something called incrementalism, or sometimes logical incrementalism, freewheeling opportunism, and all four of those are approaches towards how to make a strategic decision. Then, the last three are the ways in which we recognize strategy to be successful. What are the sources of strategic success? The traditional accounting-led approach focuses upon profit. The position-based approach is larger and says it's the degree of fit the organization can achieve with its environment, in which the organization must change when the environment does. And the final one, which is much more current, is a resource-based approach that says the organization should identify certain key resources it has and then to utilize those to enter markets and also product areas and technologies which it can exploit them to their fullest extent. In one way, you can say the approaches to strategic decisions can be broken into really two types, top-down or bottom-up. In a top-down approach, which is sometimes called strategic planning, and CIMA also call it the rational approach, this is the idea that corporate management runs the strategic decision. It does this by setting a template for planning, and there may be several years of planning will take place, after which the company will announce its 5, 10 or 15-year plan, and then it implements that through a series of performance measures and also through things like resources and training and so forth. Now, that approach was very popular back in the 1970s and 1980s around the world, but it did come into some difficulty in the 1990s and really has fallen out of some respect because companies found that the problem with this rational approach was it involved making decisions about the long-term future of the business, but with an environment where competition and technology, legislation and customer tastes were changing so quickly that any decision they made was based upon assumptions that were very swiftly out of date. So although it looked attractive to many, unfortunately it frequently led companies into making the wrong decisions, and then of course committing to those decisions for a period of many years. So in the 1990s, the strategic management approach became very popular, very much associated with an academic by the name of Mintzberg. And this is a bottom-up approach in which the organization focuses more upon its ability to adapt and change when it doesn't know what plans it should be following. Now, adapting and changing would take place at the business unit level. So the idea of corporate strategy for 15 years became less popular, and instead we have business strategies to compete in given businesses and markets against certain competitors at the business unit level. So the divisional management teams then are recruited and trained to manage businesses within strategic guidelines. Those managers learn the various tools of strategic analysis that you'll be learning as part of your E3 syllabus. And finally, there's a framework of performance management around those managers to ensure that what they do does fit in with the needs of the corporation, its stakeholders and society. But those controls are there to monitor them. They're not a series of instructions. Because under the strategic planning approach, the controls were very much targets that instructed managers on what to do. In strategic management, the controls are much more a framework which managers are expected to reach these goals, but they can decide themselves how to do it. Now clearly this distinction between top-down and bottom-up is very important to the management accountant, because management accountants traditionally had a relatively low level in the organization, simply turning the strategic plans into financial targets over relatively short periods of time. The growth of strategic management led to, as we'll see at the end of the session, something called strategic management accounting. That is the idea that management accountants should be one of the management team at the business level making these decisions. A big promotion for them. Now this diagram is the rational planning approach, and this appears in the recommended textbooks for CIMA, and it's very important you learn these stages. And the best way to read the diagram is from left to right. The company starts with something called mission and objectives. Mission objectives are the broad goals of the company and what it seeks to achieve over the next so many years. Now the length of those objectives could be 5 or 10 years away, and that's why this model here is quite consistent with a planning approach of the type that I did just mention had become less popular. Corporate appraisal is where the company does that strategic analysis of taking stock of where it is. That involves looking at its environment and also looking at its resources through a position audit. Once that appraisal has been done, there is then going to be a system of strategic option generation, blue skies thinking, in which the company would be able to talk about, and management would talk about, the various courses of action that the company could take. Evaluation and choice looks at each of these wonderful options, puts them under the microscope and says, well, which of these do we really want to do? At the end of that, there should be an agenda for several key things a company is seeking to achieve. Then there's implementation, which we talked about in terms of resources and budgets and programs, but also change management. And then that process can be reviewed and controlled through performance measurement to ensure that the position of the company improves through time. That's the rational planning approach. We talked about the bottom-up approach, and this was Mintzberg's contribution. Emergent strategies was something that he wanted to talk about. Looking at the diagram here, what you see is a company has got certain planned strategies. Now, those planned strategies are the outcome of the rational process, what the company plans to do. What Mintzberg looked at was what's on the right-hand side of the diagram here, the realized strategies. This is what the company actually did achieve over the period of time. And what interested him was that the plans the companies actually created frequently did not actually come into realization. Instead, a lot of them were unrealized. Now, reading the books of major captains of industry, they very rarely admit to the plans they had that went wrong. All you hear about is the plans they had and how wonderful it all worked. And Mintzberg said that's not really how it works. In fact, we put a lot of money into planning and we end up with a realized strategy that's quite different than what we intended. Certain strategies get crafted out. And by being crafted out, it means that managers, somewhere in the 5 or 10 years of the plan, begin to realize that this really is not going to work as a strategy, and they have to kind of forget about it. They kind of airbrush it out. Now that leaves the company walking on one leg, because it's only got half a strategy now. So those managers, because they are strategic in their thinking, then craft in these emergent strategies, which are strategies that are made up by managers as things progress. And the point I was making earlier was that the top-down approach of planned strategies was gradually being abandoned in recognition that the actual realized strategies of companies seemed to be successful when they were emergent strategies being led by management rather than by top corporate planners. We come now to the approaches to strategy. And CIMA makes a distinction in its material between 3 approaches to strategy: the traditional, positioning, and resource-based approach. Now, the traditional approach is very much the kind of thing you might have thought about if you thought that strategy was budgeting. The idea that the company's main goals are actually short-term financial objectives, such as increasing earnings per share, and then the use of effectively budgetary control to actually achieve them. Now, the problem with this traditional accounting-led approach, and the reason we now have strategic management accounting, is that the traditional approach is inward-looking. It's simply looking at the budget spreadsheets and reducing costs a bit and revenue up a bit and saying to managers, go ahead and do it. It ignores the environment, it ignores the tastes of customers, the behavior of competitors. It ignores what we'll later on call the opportunities and threats facing the business. The positioning approach has its origins in marketing planning. In marketing, as you may remember from E1, the key thing marketing seeks to achieve is making products that satisfy customers' needs. Now, this was generalized in the 1970s to a general concept of strategy. The idea of strategic success is the company fitting with the requirements of its environment. So a marketer would say, well, our products must satisfy the customer, whereas for an accountant they would say, our profits must satisfy a shareholder. And no doubt the chief legal officer would say that our activities should be compliant with the law. But the organisation has to fit its environment. Now the chief part of competitive success then was we had to have a company that could make better products than its rivals, because that means that they're going to have more customer satisfaction, more money and more profit. And to keep the shareholders happy, we have to have better financial returns to owners. Now, of course, as the years have gone by, the positioning approach has adapted wider than just customers and owners. And these days, of course, an awful lot of discussion is made of fitting with corporate social responsibility, fitting with legislation, the reduction of risk, and so on and so forth. The point about the positioning approach, or sometimes called the outside-in approach, is that once the environment changes, the organisation is rather like a ball of rubber expected to change its shape automatically. But that kind of change is hard to manage and sometimes very disruptive. Some very good companies in manufacturing saw e-commerce taking off, threw away their manufacturing capability to grasp towards e-commerce, failed and ended up becoming very poor companies indeed. Some companies have to recognise they can't fit every environment. Now, academic research, particularly led by economists, led to the resource-based approach. In economics, the rate of profit is believed to actually be determined by abilities of the organisation which give it barriers to entry to its market. Companies that have got barriers to entry make more profits than companies that do not. Now, that thinking was brought into the resource-based approach when they said, well, what makes high levels of profit for a company is not a relatively short-term thing to do with a particular product the market happens to like or a particular resource. Rather, it's more about competences that the company has, which it then can actually lever to go into new industries. So that led to the idea of distinctive competencies. The resource-based approach, this is the inside-out approach to strategy. The positioning approach was outside in, that the environment determines strategic direction of the company. The resource-based approach starts with the resources of the business, and this has a lot to do with economic thinking. In economics, high levels of profit are achieved by companies that have got barriers to entry on their market. Now, that thinking was taken forward into business strategy. The idea that high rates of profit could only come if the company had certain abilities which other firms lacked, and those became known as distinctive competencies. The idea here being then that an organisation should identify those things that it uniquely can do well. There might be things that make it very low cost, maybe ability to innovate better than others, a body of knowledge it has, access to certain patents. These sorts of things could all be distinctive competencies. The company should stick to those, and rather than just simply serve their existing markets, they should identify those competencies and say, are there any other markets which you could use those in? So various firms have been used as examples of this. For example, one is Honda, which has got a very, very reliable petrol engine technology. Now, that developed originally in motorcycles, but it's been levered into things like jet skis, speedboats, and so forth, all the way through to garden lawnmowers, and Honda is a market leader in those industries. Now, those are different environments, but the competence of the company have enabled it to move into. And the idea about the resource-based approach is that these competencies are more long-term than the particular fashions that can make a certain product successful or not. And certainly firms like Microsoft utilise its competencies in operating systems for several decades to stay at the top of its particular game. So the three approaches do have different consequences of strategy formulation. The traditional accounting approach is probably no longer seriously considered. It's probably the wrong approach, and CIMA certainly would not want you recommending it. The positioning approach still exists, and people like marketers and finance will tend to emphasise it in the short run. But in the longer run, a lot of corporate strategy is determined by a company's use of distinctive competencies. Now, all this has got consequences for the role of the management accountant. CIMA recognises that management accountants are now on the boards of companies and need to be equipped with the tools to make strategic decisions. But also, people on the boards of companies or the business units do require information to help them make those decisions and implement them. And that is the strategic management accounting concept. And as we can see here, it's got three elements: a stronger external focus, more forward-looking, and a series of quite obvious roles. So management accountants are being asked by CIMA to do things like analysing competitors, because they're part of the environment the company has got to work with. The costs of the competitors, what its competencies are, what its strengths and weaknesses are. But also to take some part in understanding market trends and prospects. Traditionally the work of the marketer, but the accountant must support that work. It must also be forward-looking, certainly longer than month-end and year-end, going beyond reporting and controlling to things like evaluation of new strategies, when sometimes they have to cope with very uncertain information, and really sometimes making a strategic decision is your best guess as to what is going to work. The main roles then for strategic management accounting are competitor analysis, understanding the profitability of customers, pricing decisions in a strategic time frame, so using the price to gain a certain target market share, understanding the portfolio of the businesses, so looking at how business units work together and not just simply the returns and profitability of each business unit in isolation, and also getting involved in corporate decision support. Now you're going to see all of these coming up in the remaining part of your E3 syllabus. What we've gone through is the key points of what strategy is, the ways of formulating strategy, and the implications of that for the management accountant's role. In the E3 examination, these questions will come up as objective test items. And what you need to do is to read very closely the detail under each of these headings, not just from my presentation, but also from the literature that you receive as part of your learning and teaching program, because the questions can be extremely detailed. But don't lose sight of the overview. This helps you to remember these topics. It shows you what's coming next. And of course, when it comes to the strategic case study, the strategic case study is not going to ask you for detailed knowledge. It's going to ask you to talk about the broad issues in the kind of reports you make to your managers. I personally think business strategy is very interesting. I hope you enjoy the rest of the sessions here with LearnCIMA.com.